The big topic of this week is, of course, Wall Street bets and the big run-up in lots of stocks seen around the world, in the American market, the Gamestop, for instance. But here in Europe, we've had names like Ericsson and Nokia taking extreme runs for them to fall back again. And this is an interesting topic that can be viewed in many ways. I'm Carl-Oskar Ström, a writer of the book Paleo Trading, How to Trade Like a Hunter-Gatherer, now on Amazon, receiving good reviews. Thank you all for that. And manager of the soon-to-be launched a hedge fund called the Paleo Fund. Now, I used the previous week's video to explain a little bit more about my background and my view of markets, but so now we will go right into it. And at the end of the video, as usual, I will always include some stocks, some charts of today's markets and the current situation there, and we can come back to that in the end of the video. But this thing about getting together in groups and pumping up stocks like they've been doing, that's been done for ages. And the new thing here is that it's more widespread and have had more clear and visible results. But there are several things to consider here. And the main topic of my book, the main theme of my total approach to the market is one of selective participation. And I think that's a topic that you should think a little bit about, because when you are, for instance, in Norway, and you start reading in the Norwegian newspapers about US stocks going haywire, and some people, at least, claiming to be, I'm sure they're right about that, having earned a lot of money on this, and then you jump on the same bandwagon, then you have to ask yourself, how early are you on the list of the even bigger fools? I think to jump to the conclusion, you have to be fairly early on this list to be one of the guys or girls who is going to earn some money on this, because you have to know that trading, as well as investing actually, is a game of skill. It's not a game of luck. And there's a lot of skilled people out there. So if you want to succeed over time, you have to be selective as to when you participate. And a lot of these stocks that are suddenly, going like a rocket, you have to be fairly early to earn some money on it. You have to be a guest in these stocks, not an investor, because some of these companies, they're just really not worth the price that they've been traded for in the market. And I know that some of them have they're initially being launched, these campaigns, as campaigns to squeeze hedge funds. And I must say that I also actually have a chapter, a section about it in the book, that at least for my trading philosophy, launching a hedge fund, very small one that is, but I would never take that kind of positions in fairly illiquid, large short positions in fairly illiquid stocks without securing them with out-of-the-money buy options on the upside, or otherwise some way of protecting myself. So some of these funds are kind of getting what's coming for them here, and I'm sure it's an expensive lesson. But for most of the retail public participating in these schemes, it will be an expensive lesson as well, because there are a couple of points here. One is you have to have a plan B. You are a guest in these stocks. You have to know what your exit is. What's your plan B? When are you going to sell, and who are you going to sell to? And if the stock, the company, is in no way worth what the stock is trading at, you are actually planning to sell it to the even bigger fool. And then you have to be conscious as to how high on that list you yourself are. It's the same as in poker, if you look around the poker table and you can't find out who the fool is, who the person who's actually paying all the others are, it's probably you. So be conscious about that. To be a guest in these stocks, always use stop losses, get out, don't hope and pray. As for really triggering short squeezes, that can happen from time to time. But a lot of the other stocks, some of the European names like Ericsson, Nokia, etc., they're very well known names. They're large companies, widely held. So when extreme runs are suddenly triggered in them, it's not necessarily likely that you can force a hedge fund to close their short positions. These companies, they can issue stocks. We've seen that in the US as well. Or you will be certain to wake up long holders who will be happy to sell you their inventory at inflated prices. So one of the Norwegian banks, they released statistics for a record week of trading, and even here in Norway, you know, investors or retail, they participated in the Gamestop stocks. It was the most traded stocks on one of the largest Norwegian banks, and they say that it was they had net purchases of 12 million kroner, that is not so much in dollars, for the week. And that was a week when the stock was down 80%. So 10 million, I could guess, approximately, of that 12 million was a real loss. Loss by you out there, the public, participating in this, if you don't use stop losses and be as a guest. Because the underlying company, it's not worth what it's trading at, and that's for sure. And there could be large swings in the value of companies, and this is a very interesting topic, and sometimes by having a currency that's hard, a stock that's trending very hard, you can use it as a currency to make your dream come true. But that again is, of course, when the company issues stocks or use their stock to buy older companies. But unlike, for instance, Bitcoin, stock is not a fixed amount. They can issue more stocks at higher prices. So then it's a matter of supply and demand, and higher prices. You can issue more stocks. Who's going to hold them? You? Well, all I'm saying is that you have to have a conscious view about this. You have to know when to participate. You have to know what triggers you to enter, and who are you going to sell to. What's your plan B if it starts going down? How to cut your losses, or what's your exit plan when you are planning to exit with a profit from your long position? That's something to contemplate.
Okay, a new week in the market is soon starting. It's time to look at some charts. I'm up here at my mother's farm, a nice landscape, a nice ski trip. And now it's time to look at how the markets have been doing since the last time I published the first tactical market update last Sunday. Well, as I said then, we were just having a few red days, small correction in the markets, but I said there was no sign at all for a more longer-term technical turn. So I guess that one was fairly good, as we have had one of the best weeks in months actually, with the Nasdaq up 5.5% for the week, as we see starting here, and now back above the 10 and 20, and of course the 50, 100 and 200 day moving averages. And as I say, I will always use a few words in these semi-weekly market comments just for you longer term holdings out there. I guess even if you're trading shorter term, there's always some parts of your portfolio, like your pension portfolio, that's held longer term. And as I said last week, as long as we are trading above the 50, 100 and 200 day moving average, it's no need to go into capital conservation mode, and one should stay fully long. So this is a very nice trending market. We just had another run up, and the Nasdaq closed at all-time highs on Friday. Looking a little bit more into the details of the market, let's look at semiconductors, who had had an okay week, but it wasn't pulling the Nasdaq up, and we see a little bit more untidy here. What we're looking at is, of course, daily candlesticks of the last year. So one candle is 1 day, and the red is opening here and closing there, and blue vice versa. Blue is a positive day with a positive momentum during the day as well. So I can see semiconductors a little bit untidy after this bearish drop down here, but it's been reclaiming this level and consolidating a little bit for a while. What was really pulling the market up in tech was big tech, the FANGs, which has had a very strong week after testing as the same thing as we've seen several times before. We can see this is the 20-day moving average, which has been capturing the trend for the last months. So it's always interesting to look at these levels and see what kind of moving average is capturing the rhythm of the market. And we can also see, and I write about that in my book, is that when all the moving averages are stacked on top of each other like this, we have a 200, the 100, the 50, the 20, and the 10. The market is per default displaying a strong uptrend, and you should stay long. Now, as for the speed of the uptrend, it's been taking on a quicker pace than it's had before, but it's not complete euphoria here yet. We are at an RSI of 66. That's close to overbought. Of course, it's a bit extended from the last week, but it's not critical, and it really, when things are closing at all-time highs without going completely bananas here, we can't really not say that we see any sign of a turn yet. And as I described last week, and you can see it again in last week's video, a topping process is just that. It's a process, and if we are going to see a topping process this year, we are at least not seeing any signs of it yet, because we are still on the way up and trading above even the most shorter term moving averages. Going into just a little bit closer view, here is the last 30 days with hourly candlesticks. We can, which is more suited for traders. You can see here lots of intraday actions. So this is the new FANG index, so it's not a stock, where you could have done nice trades. So looking at some of the large names, this is Apple, not really performing for the week, but not bad either. But it wasn't one of the winners. This is Microsoft. Easier to see here from the slightly longer term charts. It's had a strong run going from 210 to 242 over a couple of weeks, trading at was all-time highs. And we have here Amazon, of course, not really been performing for a couple of months, and are still in this what I would call a sideways range, but after a strong run earlier in 2020. So I guess this will be. It doesn't show any other sign than a consolidation that will probably be resolved on the upside sooner or later. So we'll see about that. Here we have Facebook. That's kind of drawing the same picture, but a little bit weaker. And we can also see the horizontal volume bar here, and it's traded at around exactly to 270, which is where most of the volume for the last year has been going. So it will be interesting to see. We have a couple of levels here. If it breaks above 280, it will give a positive sign. If it breaks above its own 200-day moving average at around 250, we'll probably see a drop down to this zone down here, a little bit further down. But Google was one of the stocks that really pulled the market up this week, and you can see this strong run, which of course was triggered by good numbers. And this is not really an expensive stock either, if you look at the fundamentals. So and they're of course in a very interesting strong competitive position. So this can be one of the stocks that can still pull this market further up. The last one of the high moving names is Tesla, which has of course been going sideways for a month now at what you could call high levels between 800 and 900, and that is also what I would call the signal levels in the longer term chart here. Could zoom in and look at other levels, but that will be where you can really put your alarms in to get signals for a next considerable move. And of course the trend is up, so the best guess would be for a continuation of the trend. But we can also see that after such strong runs like this, it's not uncommon to see a slightly deeper consolidation. We'll see about that. If I go into a slightly more, here is the 30-day. We don't really see anything here, but you see this is 790, 800 level. You see it's trading 840, perhaps could be a shorter term signal level. But it's consolidating, and it's what that chart is showing as well. Take a little bit look at the European markets. Get the German DAX index moving up, trading at year highs, but at a slow pace. It's really, I wouldn't say, such a good index to look at, because it's much more fragmented than the ones we have been looking at up to now. Nasdaq is fragmented as well, but it's a little bit more tech, media, telecom than this one. It's very diversified. And we can take the Swedish one. But just to the general picture of the market here is one of uptrend as well. And now we can say the same in Sweden. You can see the uptrend. You can see the fan of moving averages. So it's a strong market. It's an uptrending market. It's a stay long market, and it's a market with many opportunities. And before moving on to the Oslo Stock Exchange, we'll have a look at the oil price, which of course a commodity of importance for the oil-rich nation of Norway. But we can see the North Sea oil here. It's Brent is moving up. It's in an uptrend. It's close to 60, best levels it's been on a year. But it's close to being overbought as well. But as long as the supply and demand situation is the way that it is now, I don't see any technical signs of it turning. So this is a good backdrop for the Oslo Stock Exchange. But the Oslo Stock Exchange is trading near its 1,000 mark for the benchmark index here. It's not really showing any strength. It's in an uptrend. But it's not the most exciting view, and it has some technical resistance here at the 1,000 level, and then again at the 960 as some support here at the 50-day moving average. So I think you can look at those levels and see the next signs there. So it's earnings seasons in all the markets now. Lots of company-specific news, but at least from this tactical market update point of view, it's a good market to be in. It's a stay long market. We don't see any signs yet of it really topping out, and we'll get back to that further down the line when we see it in these. I guess I'll post it weekly updates, and if you like it, please subscribe on YouTube, and I'll be happy if some of you share the content. And of course, I have the book now out on Amazon called Paleo Trading: How to Trade Like a Hunter-Gatherer, that I published to kind of give these kind of speeches a more long form, and to take it to really give you something of value. And that's the feedback I've been given also by several that bought the book, that it's a book that pays for itself, because you will learn something of value in the introduction when I talk about the background in the markets and how they really function from the inside of a brokerage. And the last part of the book is, of course, a cookbook for traders. That's a long range of specific trading setups, starting with short-term intraday setups, going through classical swing trading, and then ending up in what I call asymmetric opportunities that happens from time to time. The last being here in the COVID-19 sell-off, and where you can really do some interesting stuff. So see you next week. Until then,